Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat. Paris milling week. 20 weeks ago, my musings on the market were thus, and I quote, "Take a look at the whole big action since the peak in May to date, that is May 2022, as possibly, just possibly, a very, very large bearish halfway hesitation in the making. To clarify, it is possibly in the making and is not made, not yet. This is a ginormous pattern and one which eventually leads down to something like the 225 area. I'm not prepared to call it that, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, currently 227 to 303, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering." And that's the end of the quote. These have all been proven to be accurate. To this bright green channel I added 13 weeks ago a mid-November to late December 2022 bearish shift pitchfork. But it got very ragged and I retired it. Instead, I drew a more recent late December 2022 to mid-February 2023 bearish Andrews pitchfork, one you can see highlighted in dark blue on my daily chart. This has done a better job of capturing the bearish angle attack, with the current market peaking up and out of the upper tie, currently at 228. Looking at the recent action, you can see the market's coming to a sort of a cusp as prices reach the point where the upper tie crosses over the lower bear channel line. And obviously one of them will have to give way. As I said 7 weeks ago, and I quote, "If there were to be an attempt lower in the near future, then that crossover period would likely be the worst time to do it unless the bearish pressure was stacked high. Far better to wait until they separate their individual ways, and thus their power individually is less than their current combined support." And that's the end of the quote. It is not a done deal on which way will give way, but at the moment the pressure from the lower bear channel line, which seemed stronger last week, is now apparently on the wane. We have some pretty heavy duty supports below that will need addressing. I'd first like to look at the 50% absolute Fibonacci line below at 218 3/4. I've highlighted this support in purple to aid in seeing it in relation to the current market. We also have emerging from below a very shallow March 2020 to date uptrend, currently at 208. I've highlighted this uptrend in bright red. None of these supports have been tested in recent times, so I'm unsure how good a support they may individually or collectively be. Plus, the shallow uptrend is so shallow that it does not reinforce the 50% absolute Fibonacci line until sometime in May next year. Just keep a wary eye on that crossing of the lower bear channel line and the upper tie. London, UK feed wheat. Back in January, as the market punched up through the short medium moving average, which is currently 195.05, up to the old previous all-time high at 238.80. Well, this old previous all-time high capped the rise, and from mid-February down to late March, we saw a drop down through the January low at 217.25, as well as the 2013 high at 215 even, the 2022 low at 206.5, and the March 2013 high at 205.05. Indeed, prices continued declining, as if the market was an area seemingly devoid of significant supports. Yet there were, or at least should have been, supports slowing and halting the decline. But those that were there gave way under bearish pressure. These supports were, in no particular order, the September 2021 low at 181.70, the supposedly powerful 50% absolute Fibonacci line at 180.5, and something I introduced 16 weeks ago, a target at 180 even. You see, I had asked the following question back late last year, and I quote, "What if the action since mid-May to date," that's mid-May last year to date, "is a huge bearish halfway hesitation, a really, really big one? In that case, we'll be looking potential down in the 180 even area. Yes, 180. I'm not as yet advocating this as a pattern, but it might turn out to be so. It will depend on how the market treats the congestion below. End of quote. Well, this target was achieved 2 weeks ago. Now, 6 weeks ago, I also pointed out, and I quote, "The action also allowed me to draw a new bearish Andrews pitchfork for the very late October 2022 to February 2023 move. Initially, I was not wholly wedded to this pitchfork, as neither the upper time, currently 182.35, nor the lower time, currently 147.60, had been tested. However, in the absence of anything else, I was minded to watch this pitchfork. And so far, it has been pretty good at indicating the bearish angle of attack." End of quote. This pitchfork has continued to be excellent at showing the bearish angle of attack, especially between the upper and middle times. This leads me to my final point about the bearish pressure, and this is the weekly key reversal down made 2 weeks ago. Here, unlike some of the other weak markets, we have seen a pretty good immediate follow-on low to this weekly key reversal down, such that the middle time was being tested last week and again this week. However, we are now approaching potentially some significant supports below. This is not the July 2021 low at 164, though I would perhaps add that this market low may have been influenced by this support. It is a congestion area formed over March to April 2019 between 161.95 to 165.75. I am not sure how the market will treat this congestion, given how it took 2 and a bit weeks to punch down through the 50% absolute Fibonacci line. But it is the next support zone below, hence it should be respected. But as technical analysts often say, the trend is your friend, and so far, the bearish Andrews pitchfork has been great at showing the trend lower. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.